Hello guys, welcome to Ninja Traders, and I'm Raj from Singapore, and I love to teach stock and options trading. So we'll be discussing vertical trades today. Welcome to this video, and the purpose of today's video is to explain you what are vertical spreads as they are called, right? So you would have seen videos on vertical spreads if you are searching for this topic, and that's how you would have ended up on this video. But I must tell you honestly, when I started to learn verticals, right, it was confusing like heck. Very, very confusing. Okay. And that is why I am making this video for you to understand what are vertical spreads in the first place. So forget about how to take them or how to take those trades. But there are terminology like bull call spread and bear call spread and bear put spread. What does it mean, right? So in this video, let's try to understand what are vertical spreads first. All right, come, let's get started. Hello. Okay, so we are going to look at why do we need verticals in the first place. All right, so you can buy a naked call or a naked put. Naked call or a naked put means that you can just buy a call and wait for the stock to go up, and if it does, then you sell it and you close your position and you make money, right? So when we can actually buy or sell naked calls and puts, why do we even need verticals? So in the past, I used to do only naked when I didn't know verticals, right? Which is long back. And what happened is I always needed a huge amount of capital. And for one position, I'm putting in like $3,000, $4,000, $5,000, even $6,000 of capital for one trade. Okay, and that is ridiculous. If you ask me today, I would say that's completely ridiculous, right? So verticals help you trade with less capital. Now, how less is less, right? So your trade can actually give you a profit of about $80, and all you need is below $200, right? So your total capital requirement is below 200 and your profit is $80. Now that's a wow, right? That is what a vertical can do for you, and that is why we should learn verticals, right? And this is what this course is about, teaching you in and out of vertical spreads, as they are called, or trades, right? So vertical spreads. Now let's go through the benefits here, right, as shown on screen. So verticals allow you to trade with very small capital, and then you also have a huge advantage that your position is buffered. So let's say you bought a call vertical and then the stock actually went down, so you are wrong now, right, in terms of predicting the direction, and then you lose money, right? So with a naked call or a put, you will lose a lot more compared to a vertical, so you lose less, right? So that's one second advantage of a spread. Now the third advantage of a spread is that you already know how much you're going to lose or make, right? So your potential profit or loss is already known to you upfront before you take the trade, so you can decide that does it even make sense, right? Like for example, if I do not make 10% of my capital, I don't even take my trade. So if my profit potential is not even 10%, if it's 6-7%, I don't even take the trade, right? So if I take a trade, at least the profit potential should at least be 10%. Now what happens if the trade is goes in the direction that I chose and it's correct in the next 1 day or 2 days, then I can actually close it even at 50% profit. That means that I got 5%. So if I assume my trade will give me 10%, so I created a vertical spread based on 10% expectation. Next day I saw 5%, I close my trade, I take 5%. But what if you take a 5% trade, right? Then you have to end up closing it at 2% or something. So it helps let you know what's your maximum profit and loss beforehand, and it works with small capital. So that's the huge advantage of vertical. And the other big thing that has been very helpful for me, at least, is that it really buffers your losses. So instead of losing $3,000 on a trade like in a naked call or put, Now your loss is $1,000, right? So it's much more manageable in that sense. And then with smaller capital, so imagine you only have $10,000 in your account. With $10,000, using verticals, you can take 6 trades, 5 trades, 5 to 6 trades. Whereas with open naked call or put, you can just take 2 trades. So when you take more trades, you basically spread out your risk across multiple companies and multiple trades, right? So that's the other advantage that we get trading verticals. So verticals it is. Once you learn verticals, you will never do naked calls and puts, right? So in this course, I'll show you how to do it, how to choose your strike prices, what happens when you choose a different strike prices, how you can place very small trades like the one I said, even for $200 trade, capital, how can you place a trade? What are the common mistakes that people do and you can do when you do verticals wrongly? And with all of that put together, you'll be in absolutely good shape to do vertical spreads and profit from them, right? So now finally, let me take you through some jargon, right? So this trading jargon that used to drive me crazy when I was a newbie in this, and it took me many years to learn all of this, and it was damn confusing, right? So trading jargon, this is one of the most irritating part. So when we come to vertical trades, what is the trading jargon commonly used, right? So let's forget about all that. Let's just understand what are you trying to do. So of course, you are either going to be bullish on a trade, which means you expect the price of the stock to go up, or you'll be bearish. You expect the price to go down. So when you expect the price to go up, what do you do normally? You buy calls, right? You buy call options. So in this case, you will be buying a call spread, which means a vertical trade is 2 trades. So you buy one call and you sell another call. That's what a vertical is. So that's why we call it a spread, right? Because you buy at strike price 40 and you sell at strike price 45, for example. So that creates a spread of $5, right? That's why it's called a vertical spread. But essentially, it's as good as buying a call, right? So when you are bullish, you expect the stock to go up. You buy a bull call spread. So the principal activity is buying a call, but a spread. Instead of like in a naked call, you just buy one call. Now you'll be buying 2, right? So that is one thing that you can do. The second thing that you can do is you buy a put when you feel the stock will go down, right? So when you buy a put, when somebody buys a put, there has to be a seller to the transaction, right? So the seller sells to the buyer. So the buyer of the put expects the price to go down, but the seller of the put expects the price to go up. So the seller has a opposite notion towards price than the buyer. So you can sell calls and you can sell puts, right? So you can be the seller, and being a seller is very powerful. All right. So I in fact have an entire course on being a seller, selling options for weekly income. So the thing here is when you are bullish, you can either buy a call spread or you can sell a put spread. Both is same, because when you sell a put, you hope the price goes up, and the buyer of the put to whom you sold expects the price to go down, right? So when you're bullish, you can either do buying a call spread or selling a put spread. Okay, so that's clear. This is the two terminologies that are associated with a bullish behavior, a bullish expectation of the stock price. But the other stock expectation you will have is bearish. So if you are bearish, you will usually buy a put. So you will buy a put spread, which is this, right? You will buy a put spread. So it's as good as buying a put, but just that you're buying one put and selling another one. So you're buying a spread instead, right? So it's called buying a put spread. And then similarly, like just we discussed the selling of a put just now, you will now sell a call. So selling of a call is also thought of as a bearish expectation of the stock price. So if you are the seller of the call, then the person that you sell to, he purchases from you. So he bought a call, you sold a call. He expects the price to go up, and because you sold, you expect the price to go down. So when your expectation is that the stock is going down, you can either be seller of a call or buyer of a put, right? So those are the two strategies. We call it bear call spread. Bear because I am expecting the stock to go down, so I'm selling a call. So that's called a bear call spread. And then bear put spread, where I am bearish about the price and I'm buying a put spread. All right. So this explains to you the terminology associated with the four types of trades we can do when we do vertical spreads. Two trades when we are bullish and two trades when we are bearish. So that clears it all, right? Now I have a course for just $88 on vertical spreads. If you want to understand how to actually take the vertical spread, how do you choose what are the strike prices, what are the common mistakes that you shouldn't be doing, and how you can actually profit from a vertical spread uh, by choosing the right spread, by choosing the right stock. So all of this is in a course, and if you wish, then the link is in the description. You can look it up, and it will definitely help you learning verticals. Now, the beautiful thing is that this course is not teaching you anything based on theory or some beautiful graphs. I directly show you taking a vertical spread in my actual account on thinkorswim platform, and you see how I take the vertical spread, how I analyze the prices, how I analyze the cost of the trade, the profit, the everything. So it's actually inside. So my teaching style is I teach you in thinkorswim what to do exactly, how, right? Period. So take that. If you like, look at the description, you'll find the link. And I wish you good luck, and I hope you profit a lot after going through this series. All right, good luck and see you inside.